Part 1 of 4 Introduction to Money and Fiat Currency. Part 1 of 4. In today's session, we will be discussing money, a critical and often misunderstood subject. Last week, we defined money, but today, we will delve deeper into our system of money in the United States, its origins, and the remedies available to us in dealing with fiat currency versus real money. It is essential to understand how our monetary system works, especially as it directly impacts your financial standing and rights. Footnote. This section sets the stage for a deeper dive into the U.S. monetary system and the relationship between fiat currency and real money. Historical context and the concept of money. Money, as defined by various scholars, is a medium of exchange, a measure of value, and a means of payment. Historically, various commodities like cattle, grain, and gold were used as money due to their intrinsic value, durability, and the ability to be universally recognized. Gold, in particular, has been a symbol of wealth and money for millennia, with its characteristics making it a viable and stable form of currency. Over the centuries, the value of commodities like gold has remained relatively stable, unlike fiat currencies. Footnote. This section explains the evolution of money from physical commodities like gold to the paper-based currency system we know today. The role of fiat currency and the U.S. dollar. The dollar, as we know it today, is a fiat currency. Fiat money is not backed by a physical commodity like gold or silver but rather derives its value from the trust and faith people have in the government that issues it. This system, while convenient, has its drawbacks, particularly when it comes to inflation and the erosion of purchasing power over time. For instance, the U.S. dollar has lost approximately 95% of its purchasing power since 1936. The ongoing decline in the value of fiat currency is largely due to the debt-based nature of the financial system, where the creation of money depends on issuing loans. Footnote. This section highlights the inherent flaws in the fiat money system, particularly the loss of purchasing power and its reliance on debt issuance. The functions of money. Money serves three essential functions. It encourages the production of goods and services, simplifies the exchange of goods and services, and provides a standard unit for measuring value and storing savings. By offering a common medium of exchange, money eliminates the inefficiencies of bartering and provides a standardized way to measure and store value. This allows for a more efficient allocation of resources and drives economic activity. Footnote. This section defines the primary functions of money, emphasizing its role in facilitating economic transactions. Methods of money creation. Money can be created in two ways, through debt-based systems or through commodity-backed systems. In the U.S., money is predominantly created through the issuance of loans, meaning that every dollar in circulation is effectively a debt that must be repaid with interest. This leads to an ever-growing cycle of debt, as the creation of new money requires the issuance of additional loans, which must also be repaid with interest. Footnote. This section contrasts debt-based money creation with alternative, commodity-backed systems, explaining the implications of each. The consequences of a debt-based system. The United States operates under a debt-based monetary system, where the issuance of money is tied to the creation of debt. This system is inherently flawed because there is never enough money in circulation to cover the interest on existing debt. As a result, the system perpetuates an endless cycle of borrowing and repaying, which can lead to economic instability. The national debt, for example, has reached trillions of dollars, and the government continues to borrow more to cover its obligations. This debt-based system ultimately benefits those who control the creation of money while burdening the general public with rising costs and limited financial resources. Footnote. This section discusses the systemic flaws in a debt-based monetary system and its long-term implications on the economy. Hypothecation and contractual agreements. One key concept in understanding the modern financial system is hypothecation, which refers to the practice of using assets as collateral for loans without transferring ownership. In the context of government agencies and private institutions, hypothecation occurs when personal or public assets are pledged as collateral for loans, such as when signing documents for mortgages, vehicle registrations, or even driver's licenses. The resulting debt, often securitized, circulates as financial instruments in the market, benefiting the entities controlling these transactions. Footnote. This section explains hypothecation and its role in modern financial systems, particularly regarding personal and public asset transactions. Remedies for debt and understanding securitization. Securitization is the process of converting debts into negotiable securities for resale in the financial markets. By securitizing assets, such as mortgages or loans, financial institutions can remove these assets from their books, improving liquidity and capital ratios. However, this practice raises important questions about the true ownership of these debts and the standing of debt collectors to enforce claims. For individuals facing foreclosure or debt collection, understanding the securitization process and how it relates to their obligations can provide important remedies. Footnote. This section introduces securitization and its impact on debt collection, providing insight into potential remedies for individuals facing financial challenges. The role of the Federal Reserve and monetary policy. The Federal Reserve, as the central bank of the United States, plays a key role in managing the country's monetary system. The Fed's primary function is to regulate the money supply and control inflation through monetary policy. However, the Federal Reserve operates as a privately owned institution, making decisions that have far-reaching implications for the economy. As the issuer of the U.S. dollar, the Federal Reserve is also responsible for ensuring that the nation's debt remains manageable, which often involves manipulating interest rates and engaging in market operations. Footnote. This section explores the Federal Reserve's role in shaping U.S. monetary policy and its influence on the global economy.